This is Movers and Shakers, where we interview the upcoming generation of Make It Happen multifamily investors to share their story.
Welcome to the Movers and Shakers podcast. My name is Gino Barbaro, co-founder of Jake Gino, multifamily investor, educator, father, mentor, and I am joined by my co-host, my brosif, Josh Rusin, the community director of Jake Gino. Josh, how are you doing today?
Gino, doing well, man. Super excited. A lot of big things happening. First and foremost, I'm excited about some John Maxwell leadership training that as a company looks like we're all going to be going to. Second, I'm excited. We had an amazing multifamily mastery live. There was Eric Thomas, some high-level speakers there, and a lot of upcoming student events as well. Boot camps, money mixers, various things like that. Gino, what's going on in your world today?
I'm having a good time. We have some great guests. Kent's going to come on right now. We're going to speak to Kent in a little bit. I met Kent a couple of years ago. He's one of the first Jake Gino students, and it was great meeting him. We have a lot of, things in common, and I'm just here to, and really glad to share his story with you guys today.
Speaking of Kent, let's dive into his background. So today's guest is Kent Ritter. He's an experienced real estate investor with investments in over 1,300 multifamily units. He believes that apartment investing is one of the surest paths to financial freedom. His purpose is to provide opportunities for others to achieve the success he has experienced by investing alongside him. Prior to founding Hudson Investing LLC, he was a partner in a management consulting firm where he held several key leadership positions and played a key role in growing the business to 95 employees and $30 million in revenue in 6 years. His strong analytical background, experience managing change, and business acumen gained as a business leader and an advisor gave him a competitive edge as a real estate investor. Ken is blessed with an incredible wife, 2 daughters, and a son. They are his joy and his why. Welcome to the show, Kent.
Thanks, guys. Really an honor to be here. Appreciate you having me. I do feel like this is really coming full circle with where we started, like 3 years ago. It was like the first multifamily mastery event was really my kickoff into multifamily investing.
So that's only 2 years ago. So don't cheat yourself. 2 years ago? November of 2017. That's right. That was November 2017. It feels so. We're at our third event. So
yeah, you're right.
What's amazing about that was I'm going to share a little bit of the story with Kent. Kent goes to the live event. We meet. He joins the Jake Gino platform. And one thing that really stood out with Kent's story with me that resonated, and it resonates with a lot of students that I try to talk about with multifamily, is we all come in with a certain mindset about what multifamily is and how we get into multifamily. And I see Ken shaking his hand because he knows where I'm going with this. We all think we need a lot of money. We all think we have to buy deals ourselves. We don't know what we don't know. I mean, I remember speaking to Kent, and he came to our first boot camp in Knoxville, and he's touring the properties and he's learning, and we're talking about syndication, and Kent's sitting there goes, I never really thought about it that way. And I thought I had to buy them myself, and how is it going to scale? So I guess my first question to you is, what did you take away from the education? What were the big aha moments when you actually joined the platform and started learning?
Yeah, I think there's a couple. So one, just the foundational knowledge that you guys had as I was getting started. I mean, really just speaking about the platform, just starting with the podcast. I mean, you guys were really the first, I think you're the first real estate podcast that I really found as I was coming out of my previous career and saying, what do I do now? You know, it was really finding you guys, finding your podcast, saying, wow, you know, that sounds like something that is really interesting. Going to the meeting like we discussed, and then joining the program, and then all the online training you guys had was really the foundation for teaching me about real estate and about multifamily. And then from there, I think it was the community, you know, and just having the community like exploded around me. Like you said, I was, I guess, one of the first students. I kind of knew that. I think I was probably the first one that Josh got on board because he had like just started. And
it's all downhill from there. If you're the best,
yeah, right.
All downhill from there.
But it just blew up from there around me with the online community, and then the on-site in Knoxville. I mean, just getting to look and feel at other properties. You know, I think that just gave me confidence to say, you know what, I think this is something, because I had been passively investing as an LP. It gave me the confidence to say, no, this is something I think I can do on my own. And then, yeah, Gino, you really blowing my mindset up, just saying, I'm like, yeah, okay, I'm going to go do something small over here, over there. And, we just closed, I know we'll get to this, but 3 weeks ago, just closed as a co-sponsor on 250 units in Atlanta. And I mean, there's no way 2 years ago that I would have even had that in the realm of possibility. So, really you were valuable in taking my mindset, just expanding that. And now I couldn't imagine doing anything small like I wanted to start with. It just doesn't make any sense to me.
But what's great about it though, Kent, is it took you time, right? I mean, it didn't happen overnight. It was an evolution. You invested in your education. You invested in the time. I think you also invested in the right vehicle, which was really good for you. Why multifamily for you? Why did you select multifamily?
Yeah. So I went through a very typical process, right, of looking at different avenues and saying, single family and, should I go and buy a few single families? Should I buy some commercial buildings? What should I do? And really landed on multifamily because luckily I had some good mentors. I mean, you were one of them and a few others that led me down that path to say, hey, look, single family doesn't scale. It's not the way to go. Let's just help you, bypass that pain point. Most people go through that process and realize that, it doesn't scale and they can't really, find their financial freedom doing that. Luckily I had good mentorship. I was able to skip that step. And that really led, as I was looking around in other asset classes, I did some investing in industrial, a little bit in some commercial office. And I like multifamily though, because it's simple. It's easy to understand. It's ubiquitous. Everybody needs it. And there's just a supply and demand dynamic that exists that isn't going away, that I think makes multifamily favorable into the future. So to me, it was the right place to land because of just the market dynamics and the scale it provides.
What do you think you learned from the platform more than anything that really helped you? Because when I started coaching and I started going through my mentorship 10 or 15 years ago, there was a really few key takeaways. I learned how to underwrite a deal a lot better. I learned how to select a market, which really helped me out. Syndication was not a big key term when I started years ago.
Right.
But partnering on deals, they helped me out a lot. And also a little bit of the management process. What were your big key takeaways? What did you need help on? And what did you learn that you didn't know?
Well, I didn't know a lot, and I didn't even know what I didn't know. So I'd say that was the biggest thing overall, was just having the resource to understand every aspect, buy right, manage right, finance right. And now I think there's even more rights, right? So getting in there and just understanding the process from beginning to end, I'd say one of the biggest takeaways was the underwriting. I think it's so critical. And, I have an analytical background. I spent a lot of time in Excel, but it's not about typing the numbers into a spreadsheet. It's about knowing, what makes sense and what is possible. And, and just being able to understand, when things look off, right? And having you guys as a sounding board to help me, make the right decisions and not get excited about something that a broker's talking about, right? And go and run with that and pay too much. And I think, so really the idea of buy right and you make your money when you buy. I think those things and sticking and being diligent with the underwriting, I think those were the aspects that really helped me as I got started.
So what was that first deal look like? How did you get into your first deal, and what was the value or the component that you looked at in this deal?
Yeah. So the first deal and the most recent deal are different, but from a first deal perspective, the first deal was really a joint venture among there were 5 of us that we went into, and it was, there was someone in it that was more experienced, and it was really a way for me to come in and be a part of the deal and to kind of learn side by side. And I was really more of a backseat player, more helping, more, checking things and, I'll be doing calls, checking with vendors and things of that. So it wasn't as much of a front seat position, but it was a great, kind of, I was sitting shotgun to the deal and able to really see it play through.
And this more recent deal, what was the difference between this more recent deal then?
Yeah, the more recent deal was a true syndication. So I co-sponsored it with a couple other folks that I had met just through networking events, and we had grown relationships and said, if it makes sense to take down a deal together, let's partner up. And they found a deal in Atlanta, which is where they're based. And we were able to partner on it, and I was able to help and complete, help with some underwriting, help raise capital for the process. And then, also helping from the asset management standpoint now that we're closed and we're beginning the process. So we are, we're kind of co-asset managing, we're sharing some responsibilities. We're meeting on a monthly basis to go over the business plan, make sure things are playing out, and they're acting more as the boots on the ground and the day-to-day.
So what did you like about this deal?
So I like the deal. I like the location. I think it starts there, and Atlanta is having huge growth, right? The net inflow there has been pretty incredible, and there's a lot of job growth, particularly the markets that we're in, which is the northeast part of Atlanta, have seen really significant rent growth, and I think they're going to continue to. They're nice, kind of upper middle class areas. The deal really was, it's a 250 units. It's two buildings, so it's a portfolio, and really what happened was it's really just a management issue more than anything else. So the properties were pretty clean. One was built in 83, the other was built in 2003, and there wasn't a ton of deferred maintenance. So we knew going in that if we could come in and bring professional management, and if we could really just modernize the units and spend the CapEx on things that are going to add value, we could get a nice return. So I like that it was fairly simple. There wasn't a lot of hair on it. It was really just a partnership that had dissolved, and they weren't paying attention to the property. So it was an opportunity to come in and just manage it better and go through a value add program. And what we saw in the market was that this property was $160 under market rent. So as we were underwriting it, we were able to underwrite at $100 on one property, $125 on the other property, and still keep a nice cushion between us and the market, and make our numbers with that. And then if we're able to get up to 160, that's just gravy on top. So there was a lot of room in the deal for us to be conservative and still make the numbers work.
Kent, where did you find this deal? Was this an off-market deal or?
So it was actually, my partners had built a relationship with a broker down in Atlanta, and it was one that had kind of been lost and then came around again. And because of the relationship with the broker, they were there, they were ready to pounce. And we said, yeah. The broker said, are you guys still interested? And we said, yeah, we're interested at our price. Mm-hmm. And they took it, and the rest is history. So
what are your thoughts on partnerships? I have a lot of pushback from people that I say that they could never partner, and they've had some bad relationships and bad partnerships. We all have. I've had a couple myself, and I continue to seek out partnerships. What are your thoughts on partnerships?
Yeah, I've had good partnerships and I've had bad partnerships. I think partnerships are a key to success. I think that, I guess what I think specificity and working with your strengths is a key to success. So I think if you can find a partner that complements you and allows you to focus on your strengths and allows them to focus on their strengths, I think that's the key.
I'd like to add one other thing to that also, setting expectations. Setting proper expectations, having those monthly calls, doing what you say you're going to do and saying what you're going to do is really important. And everything you said makes total sense to me also, but having those expectations, if you're going to get on a monthly call, don't blow your partner off. You need to do that. I think that's really important.
Yeah. I think being realistic in what you want as well. I've had people approach me to partner that, just wanted way too much. They wanted more than the value that they were going to bring from my perspective, So I think just being humble and being self-aware, and, in this deal, recognizing that, my partners are more experienced syndicators. And so, I recognized kind of where I was, I'm a newer kid on the block, but it was an opportunity to be involved and to add value and, and to get some more track record. And, just kind of taking that humble approach allowed me to be a part of the deal and gain a ton of experience, which is going to, help me later on.
So I was just reading the quote in the Bible, book of Matthew. Those who will be exalted will be humbled, right? And those who are humbled will be exalted. So when you first start out, and even when you're an expert, you should never exalt yourself because there's so much to learn. And your partners understand that, right? Because your partners probably need you and you bring value to them. And I think they bring value to you. So as you go on through this journey in life, never exalt yourself because there's always so much to learn. There's always so many things you'll never know what you don't know. This thing called real estate is constantly evolving. Syndication wasn't around 5 years ago. I knew nothing about it. So there's always something to learn. Markets are always constantly evolving and changing. There's always new debt instruments coming out, Fannie and Freddie, private lending, CMBS, all these things are coming out and new. And I think if you have an open mind and you're willing to partner and willing to learn, I think it's an amazing journey. That's what I love about real estate.
Yeah. The only other thing I'll say about partnership related to real estate is I love that you can, people are pretty open to partnering on a deal specific basis. So you can date somebody without getting married. You don't have to enter a 30-year business partnership. You can
Josh likes
deal.
that one right there. See, Josh, I see Josh smile at that. Yes, real estate all day, bro.
Yeah, but it's great because what I've really focused on is building my network, and the Jake and Gino community was a huge part of that. And from there I expanded into other networks, and through that, just meeting the right people. You meet people that you resonate with, and in doing that, you can find people that you enjoy to work with. And the nice thing about being an entrepreneur is you only have to work with people that you enjoy working with. So I think that's another great thing about real estate and about the way that you can structure deals.
I love that. As Rick Sapio says, it's all about value-based decision-making. It's based on your values. And if you understand that, you just gravitate towards people who you want to work with. And that's really important. Now that you've taken this deal down, are you still looking in the Atlanta market? What's your next steps? Are you going to be venturing out to different markets or?
So I'm primarily looking locally. I'm based in Indianapolis, primarily looking in Indianapolis. And I've drawn like a 3-hour radius around Indy, staying out of Illinois just because of tax and some of the laws aren't as friendly.
Stupidity. Yes.
Yeah.
You can say
there you go.
Show. Yes.
And then, but Indy, Louisville, Lexington, Columbus, Ohio, those are markets I like. Indy, I've, it's a great market. There's good growth. It's very solid. I think there's a lot of positive things about the market, but I've been second place quite a bit here. As we go into best and finals, just because the deals as they've ended, I've kept my diligence, and I haven't paid more than what the numbers would bear. So haven't been able to do a deal here. That's what led me to start looking broader and focusing more on partnerships in markets like Atlanta, Charlotte, Raleigh, other places that I really like, but I'm not local and I'm not boots on the ground. So I think that's a big thing for me. I don't know how you do this work in the level of detail you need to do it without being there and being boots on the ground. So I focused on finding good partners that are in markets that I like.
And I think you're playing the long game. This part of the market cycle, if you're not finding deals or you're underwriting them, you're losing them, let the brokers know. Send over your underwriting and say, I'm sorry, this number at $5 million doesn't work. It really works for me, 4.3. And here's why. And I think they'll have a lot of respect for you. And a year from now, when these deals are falling out and there's more deals coming on the market and things start to slow down, you already have the long game going. I mean, so I think that's what people need to do. And I think the deal that you bought in Atlanta is really, we teach on the 3 pillars of real estate. Bill Ham loves to talk about it. He talked about market cycle, debt, and exit strategy. In this part of the market cycle, you've bought a great asset because it's a newer asset. It has very little deferred maintenance. So it's newer. You don't have to worry about cast iron pipes. You don't have to worry about putting a ton of money per door in this thing. So when the market does turn down, you don't have a ton of money in this deal right now. And it's one of those deals where you can cash flow nicely, and it's a management play, which is great because you knock off expenses, because every dollar of expense you save, it's $1 to the bottom line. So that's another great thing. So I think if everyone looks at a deal and starts analyzing deals, one of the things you need to do is look at those 3 components. You look at the market cycle, and every sector, every market city is in a different market cycle, whether you can be in a recession. Very, very few cities are, but there still are some cities that are recessionary, and you have all the way up to hypersupply, which Atlanta can be sort of on the hypersupply. They keep delivering thousands and thousands of units, but their population growth and job growth are absorbing them now. Now, if there's a slowdown or a downtick in the market, that might change things, but it hasn't for the last few years. So you just have to be careful of that market cycle. And then your exit strategy, obviously, are you going to hold it, refi, flip it, and then your debt component, which is what kind of debt are you going to be putting on. So when everyone's underwriting deals, look at all 3 of those components. It's really important.
Yeah. So for example, we did, we're planning to exit in 5 years. We did a standard 5-year exit, but we put 10-year fixed debt on it because we don't want to be in a position where we have to sell, right? We want to be able to sell at the right time. The other thing we did was we underwrote the deals. We financed the deals. or the properties separately. So, they're not cross collateralized. So it allows us, again, the flexibility to sell as a portfolio or to sell individually. If one of the deals takes off and we make the numbers, it allows us to sell that and hold the other. We understand where the market cycle is. So we're trying to build flexibility in everywhere that we can. So I think the fixed debt, the 10-year debt allows us to, if it's year 5 and we end up at the bottom of a recession, we have the flexibility to hold on 5 more years if we need to and just cash flow it.
So a couple of questions on it. Did you have separate LLCs for each property? There are separate LLCs?
Yep.
So that's great. So you have different loans on it. Do you know what your interest rate was, more or less, around where it was?
3.64.
So dude, that's a home run. I mean, that's exactly what we got about 2 months ago. And it's do you have any interest only on this? You probably have 3 or 5 years, right?
3 years. Yeah.
3 years. That's awesome. Yeah. So it's non-recourse. Do you know if it's step down prepayment or yield maintenance?
It's yield maintenance. But the way the interest rates were so low, we feel that, even the way we modeled it, even on the way out, if we exit early, there's still going to be plenty of upside.
Yeah. So
even paying those penalties
at 3.64%, I mean, that's a great rate. You can pay a little bit more. And the important thing about it is your entry cap is not as important, right, on this kind of deal, because there's so much meat on the bone where you're actually going to raise rates. And also you're buying it at such a good debt component and you're locking it in for 10 years. So you're trying to take that interest rate risk off the table. You got your exit strategy in place. So you're trying to limit your downside risk when you're buying these deals and going through all these different analyses. It's really cool. It's really awesome.
Yeah. The other thing I'd say is just how important submarkets are, because you mentioned Atlanta, and in Atlanta, there is a ton of people building, right? Atlanta has a lot of developers, a lot of local developers. A lot of that's happening on the periphery, right? And it's happening on the outside. Our property, one of them in particular, is more of an infill property. So we looked at that and said, okay, this property, there's some barriers to entry there because you can't just plop another large multifamily down right next to it, right? So we feel a little more protected there, but I mean, recognizing that in Atlanta, you do have to be careful because the supply is growing all the time.
And that's awesome. That's a great point. That's someone who's really educated themselves on the market. And we like Buckhead. We're having our Buy Right boot camp in November in Buckhead, and in our ones for our students in January in Buckhead. Also, we love the area. It's a really, I think the median income is like $120,000 there.
Yeah.
It's really, really nice area. The assets are expensive there, but it's just one of those areas where it's growing. And that's when you start looking at markets. The Atlanta market might be a 7 or 6 cap for the entire market, but Buckhead is a 5 cap. So you really need to know the sub-market of the city you're in and really drill down and know that barrier to entry is a really great number to know, because when you go to sell, there's less to buy there. So your property is going to be more demand. So that's another important component when you're trying to get your exit strategy. I love that. Thank you.
Yeah, absolutely.
So Josh, what questions do you have for Kent?
All right, Kent, got some short answer questions here for you. What's your best tip for a listener that's trying to get in their first multifamily deal?
Let's see. So, I mean, going back to what we said before, I mean, stick to your numbers and don't get emotionally attached. I think that's one of the biggest things that, I went through at the beginning. It's like, if you spend 4 hours underwriting a deal, like, you want that deal to work, but if you find you're at the point where you're tweaking percentages here or there, you're like, what if rent grows at 3.5% versus 3%? Will that make the deal work? Like, if you're doing that, just stop, just move on to the next one. Bill Hamm actually gave me great advice. He's like, the best way to, what did he say? He said, the best way to get over the deal that you're working on, go look at 30 more. And it's true. It's, you have to have that context of looking at just a ton of deals and building a process to move very quickly from deal to deal. You can't fully underwrite every single deal. You've got to have tiers, that let you quickly evaluate, okay, these aren't good. These I'm going to move into the pile. These I'm going to look further into. But I mean, for every 100 deals, you might underwrite 30 of them. You might put an offer in on 10 of them. You might get one, or you might not get any, depending on where the market's at. So I think you got to build systems to handle the volume, and don't get emotionally attached. Just move on.
So Kent, you're giving my boy Josh some mixed signals there. You're saying not to fall in love. You can partner with multiple people, and you're saying not getting emotional. I'm trying to tell Josh to get emotional and to get involved. So we're talking real estate here, Josh. So don't get those mixed signals. This is only real estate, okay, brother?
You got to separate love and deals.
Yeah. But all joking aside, this is totally serious, and this is really important, everybody. Do not fall in love with the deal. Picture this. 10 years ago, I'm in New York. I've got a little bit of money. I go invest in a deal because I fall in love with it. It's a nice shopping center. I can really fix it up. It looks beautiful. I can get the renters in there. The numbers make sense. Well, fast forward till June of 2017, I sold that for a huge loss. Why? Because I fell in love with the deal. I should have fallen in love with the market and the job prospects. I bought it the wrong part of the market cycle, but I held it long enough where if it was in a decent market, it would have recuperated. The market sucked. I fell in love with the deal, and it was more of a trophy. The first deal that Jake and I bought was a 25-unit crack den. Anyone looking at that property, they'd be embarrassed to own it, right? I love that deal because it paid me triple. It's making me $3,000 a month for the last 5 years. I don't care what the property looks like. It all comes down to the numbers and if it's going to make sense to you. So don't fall in love with the number and don't go through what I went through, because 10 years, it's not even the money that really hurts you. It's more of the aggravation. Every time that phone rang and I saw that property manager, every time everything was a problem, that really is a time suck. You don't have enough mental capacity to deal with a bad deal. So I want to say also, no deal is better than a bad deal. And Kent hit
That's
it right on the head with 100. I mean, Bill Ham likes to say the race to 80. If you can underwrite 80 deals, you're probably going to get one. Now, when things are a little bit slower and you're more in a recession, recovery kind, you might knock that number down to 40. But you're going to have to look at 80 deals to actually get that one deal. So what are you doing today? I challenge everybody out there, start underwriting those deals if you want to get into multifamily.
Yeah. The other thing I'd say, which I guess it goes back to this theme with Josh, but it's, you got to start building relationships right away, right? I mean, the brokers, lenders, property managers, and investors. If you're gonna take on investors, you got to start warming people up to what you're doing. You have to change the perception of how they see you, especially if you're going to raise money from friends and family. That was probably my biggest lesson learned from raising money, was folks that I had worked with for a long time. It wasn't as easy as I thought it was going to be. It really had to change their perception to not view me as a coworker, as a consultant, to view me as, an investor and someone they would trust, handing, $50,000 over to. So it's something you can't start early enough building the relationships. I know you guys have the credibility book that helped me a lot at the beginning. I created a version of that. I would send that out to brokers to kind of announce who I was and to talk about what I was trying to do. And as you're doing that, just be really specific with what you want. Don't be wishy-washy. Say, I'm looking for 100 plus units, 1980s plus vintage, B or C class, and hopefully say in the following areas, because the submarkets.
Mm-hmm.
So be as specific as possible, but just talk to your brokers every couple weeks and make those relationships early.
Love it. What about your best habit for success and why?
My best habit for success is two things. I'm a big Miracle Morning guy. I believe in that system. I've got 3 small kids, so the only time I get to myself during the day is early in the morning. So wake up early and meditate. Try to meditate every day. I think that helps me keep clear, helps me focus on my priorities and just get all that noise out of your head to start the day right. So those are my big tips.
Love that. What about your favorite book?
So my favorite book, I actually just reread Never Split the Difference by Chris Voss. And I think you guys have interviewed him maybe a couple times,
Mm-hmm.
but I had read it a while back. I just went back and reread it. And I mean, there's so many gems in there. I mean, it's one of those things that just in reading that book and applying those principles in my negotiations, the stuff works. I mean, it really does work. And I think one of the things that it's not actually in that book, but I think I got it off their website, is they have tips around email, how to get responses to emails, and the stuff that they say really does work. All of it's counterintuitive, but it really does work. So I'd say, yeah, never split the difference.
Like it. Gino, there were some golden nuggets in this one. I want to wrap some of them up. So first off, you don't know what you don't know, and you got to be careful of that. Second, the power of partnerships, as you saw with two of the Ken's deals we talked about, he had other partners in them. The next one's don't fall in love and don't overpay on a deal. And then build relationships, right? Not only with partners, but with brokers and other team members to make things happen. Gino, what takeaways did you have from this one?
You took most of mine away. I think the relationship piece is important, right? I mean, you need to build relationships and get out there and start networking with people. And if you don't feel comfortable doing that, then I don't think multifamily or business in general is for you. But I think if you have a strong enough why, you'll get out of your comfort zone, because I don't like standing in front of a stage and talking to hundreds of people, but I need to do that now because I'm part of Jake and Gino. So that's my why. I know why I'm doing it. I think don't fall in love with the deal, fall in love with the numbers and the ability of adding value to that property. And I think the three pillars that we mentioned are really important. So every deal is unique. And like Ken said, when you're first starting out, try to underwrite as many deals as possible, because you want to know when you're looking at a deal in Indianapolis, what the cap rate is, how much rent growth you can get. Can you do rubs on this? What are the utilities in that market? What is the insurance? Where can you save on expenses? What are the property management fees going to be on that property as opposed to what they're paying? So it's really important to underwrite as many deals as possible. And as you're putting in offers, you'll see which ones stick out. And when we say look at 100 deals, when you're really quick at it, you can get that done in a relatively short period of time if you've got experience. So I think just getting out there and putting in the work will really lead to your success.
I love that. Kent, how can the listeners get a hold of you?
A couple ways, on LinkedIn, they can find me, Kent Ritter, very easy to find. That's how most people actually find me. You can find me at my email, kent@hudsoninvesting.com. And we have a website coming soon. It'll be www.hudsoninvesting.com. And it'll be up there in a couple weeks. So, anywhere of those, they can reach out to me.
Awesome. I want to thank Kent for being an amazing guest on the show and sharing his movers and shakers story. Guys, if you want to be the next guest on Movers and Shakers, email me, josh@jakeandgino.com. And please, if you like this show, go ahead and leave us a review. And until next time, let's make it a Movers and Shakers week. See you, everyone.
Thanks, Kent.
Thanks so much, guys. Appreciate it.
Josh, I'll see you later, Josh.